This is MeetSean, where we break down real life topics insurance, annuities, real estate, travel planning, and home ownership so you can make smarter moves. Subscribe so you don't miss the next episode.
Welcome back to the deep dive. Today, we're going to be wading into a topic that, let's be honest, most people try to avoid until it's way too late. We're talking about planning for the inevitable, and more importantly, how to remove what can be a really devastating financial stress on your family when they're most vulnerable.
That's right.
We are diving deep into final expense insurance. You might also hear it called burial insurance.
Same thing.
And it's designed specifically to cover those end-of-life costs, but the rules, the scope, all of that often gets blurred with traditional life insurance.
It does. And that's our mission for you today, to really clarify that picture. We're going to unpack the exact purpose of this coverage and maybe more importantly, highlight the key differences between this and the big traditional life insurance policies, all based on the material you sent over.
So by the end of this deep dive, you'll walk away understanding three things. First, why the payout is small and fixed. Second, how the application can be so simple. That's the simplified underwriting we hear about. And third, the really significant trade-offs that come with that simplicity, specifically those waiting periods.
Exactly. Let's get into it.
Okay, so let's start at the very beginning. What exactly is final expense coverage, and who is it really for?
The best way to think about it is as a really specialized subset of whole life insurance. Its design is hyper-focused.
Okay.
It gives your family a relatively small, predetermined cash payout. And that money is specifically for the immediate costs that come with a death, funeral, burial, and all the fees that go with it.
So it's purely logistical. This isn't for replacing an income or paying off a big mortgage. It's just to make sure the family doesn't have to rack up credit card debt to plan a memorial.
Precisely. It's a proactive measure. The sources we looked at really emphasize that its main value is peace of mind. It prevents that sudden financial shock.
Because when a family is grieving, the last thing they should be doing is trying to figure out how to pay for a casket.
The absolute last thing.
And a big reason this product even exists is for accessibility, isn't it? I mean, if you're older or have health issues, getting traditional insurance can be, well, almost impossible.
Absolutely. The sources are very clear that the target audience is primarily seniors, usually people between, say, 50 and 85.
Right.
For them, having affordable premiums that work on a fixed income and that streamlined underwriting process, those are huge selling points. If you've been turned down for other policies, this is a way to guarantee those basic costs are covered.
It really does fill a very specific gap in the market.
It does. It's based on the idea that everyone deserves to pre-plan for these expenses, regardless of their health history.
That makes perfect sense. Okay, so let's get into the specifics. When people hear funeral costs, they often, I think, underestimate the total bill. Based on the sources, what does that payout actually cover?
This is where the numbers get really important because they show you why this kind of policy exists in the first place. We can break it down into three main buckets of cost. First up, you've got the core funeral services. This is what the funeral home charges for its basic work, preparing the body, using their facilities for viewing, that sort of thing.
And what's the average cost for that part?
The sources cite a range of between $7,000 and $10,000.
Wow. Just for the basic service.
Just for the service.
That's a huge amount of money right there. I mean, that's already a big chunk of the minimum policy payout you see advertised.
Exactly. And that brings us to the second bucket, the actual burial or cremation expenses.
So the plot, the casket.
Right. The physical side of it. The plot, the casket itself, a vault, or the fees for cremation. And for that category, you're looking at an average cost of between $3,000 and $6,000.
Okay, so if you add those together, you're looking at a baseline expense of, what, $10,000 to $16,000?
At least. And that's before you've even bought a single flower.
Which I assume is the third bucket.
That's the third bucket. Additional costs. All the little things that add up incredibly fast. Flowers, printing memorial programs, obituaries, and a big one, the headstone or grave marker.
And how much does a headstone cost?
Just the marker alone, the sources say, can cost between $1,000 and $2,000.
So when you put all that together, a $15,000 policy isn't overkill at all. It's really just cost mitigation. It helps, but it might not even cover everything in, say, an expensive city.
That's the key insight. It's designed to make the immediate costs manageable, not to replace a lifetime of income.
And when the policy pays out, who gets the money? Let's talk about the beneficiary's role here.
The money goes directly to the person you designated as your beneficiary. That individual then becomes responsible for taking that cash and paying the funeral home, the cemetery, all of it.
So they're basically the financial executor for your final wishes.
That's a great way to put it.
That's a perfect transition into the limitations, because so far it sounds pretty good. Easy to get, affordable. Where's the catch? What is this insurance definitely not for?
This is a really critical point. Because the payout is small and fixed, this is not, and was never meant to be, a replacement for general life insurance. It's a funeral bill solution, period.
Which means if you still have a mortgage or significant medical debt, you need a different kind of policy.
A completely different policy. The sources are very clear. This payout is not for outstanding credit card debt, medical bills, mortgage payments, utility bills. The money is meant for the funeral and burial.
Understood. Okay, let's talk about that big trade-off. We keep saying simplified underwriting, which means no detailed medical exam. But there has to be a catch for the insurer. How do they manage that risk?
This is where you find the real engine of how these policies work. The insurer manages their risk with something called a graded benefit.
A graded benefit.
Right, that's the trade-off. Because they skip the deep medical checks, they have to protect themselves from people who know they're very sick, buying a policy today and passing away next week.
So the graded benefit is like a waiting period before the full coverage kicks in.
That's exactly what it is. If the policyholder passes away during that graded period, usually the first 2 years, the beneficiary often just gets back the premiums that were paid in, maybe with a little interest, not the full death benefit.
So you have to survive that waiting period for the policy to really do its job.
You do.
Can you give us some specific examples from the source material? How do different health conditions affect this?
Sure. The sources show that for conditions that imply a higher immediate risk, the waiting period is pretty strict. For example, an applicant with diagnosed heart disease might face a 2-year waiting period.
So if they die from a heart attack in year 1, no full payout.
Correct. Similarly, cancer is often cited as a condition that could trigger a 1-year or sometimes 2-year exclusion or waiting period.
Wow. So you really have to be healthy enough for long enough for the policy to deliver on its promise. That changes things.
It absolutely does. You have to think about the payout timeline right alongside your current health. But interestingly, the sources offer a contrast with diabetes. While having diabetes might make your premiums a bit higher, many policies are cited as having no waiting period attached to it. It shows that insurers see chronic conditions very differently from, acute high-risk ones.
That just hammers home the need to read the fine print. Simplified doesn't mean no catches.
Never assume. Yeah. The health questions you answer are specifically to figure out if you need that graded benefit or if you qualify for full, immediate coverage.
Which brings us to the core comparison. Final expense versus traditional life insurance. They both provide a death benefit, but they are clearly for completely different situations.
They serve unique masters, for sure.
Yeah.
The first difference is just the scale of the money.
Right.
Final expense is small, fixed, and focused, usually somewhere between $5,000 and maybe $25,000, just enough for a funeral.
Whereas traditional life insurance, that's for paying off a $500,000 home or replacing an income for 20 years. The scale is it's a different world.
It is. The size of the payout reflects the size of the financial problem you're trying to solve.
Then there's the application process. We know final expense is simplified. How tough is the traditional route in comparison?
It's night and day. Traditional life insurance, especially for a big policy, requires full medical underwriting.
Blood tests, the works.
Blood tests, urine samples, a detailed health history that underwriters review, access to your medical records. They are assessing your risk down to the finest detail.
While the final expense route is built for people who just can't clear that high medical bar.
Exactly. The lower coverage amount and the graded benefit allow the insurer to skip all that, which makes it an option for people who otherwise couldn't get any coverage at all.
And the final difference is the duration.
It is. Final expense insurance is almost always a whole life policy. It's permanent. As long as you pay the premiums, it lasts your entire life.
But with traditional, you can get term life, which only covers you for a set time. So final expense is permanent because, well, the funeral is a permanent, inevitable cost.
That's the logic, exactly. A funeral is a certainty, so the policy that covers it has to be a certainty too.
Okay, let's get practical for a minute. If someone in that 50 to 85 age range decides this is the right tool, what does getting the policy and then using it actually look like?
The process is designed to be as simple as possible. You choose a provider, fill out the application, which has basic personal info, and then those very specific, often yes or no, medical questions.
So just to recap, choose a provider, fill out the form, answer the health questions, and wait for approval. What kind of documents do you need?
Even with a simple process, you need the basics. A government ID, honest answers to the health questions, and your payment information. And a big plus for budgeting is that the premiums are designed to stay the same over time.
That fixed premium is huge for someone on a fixed income.
It is.
Now, here's a critical point for the beneficiary, the timeline. If the family needs this money for an immediate funeral, how long does that death benefit actually take to arrive?
The source material says it usually takes a few weeks to get the money after a claim is filed. And this is really where the rubber meets the road.
Wait a minute, a few weeks. Funeral homes want their money up front, or at least within a few days.
That's the practical gap.
So if the policy is designed for immediate costs, but the payout takes weeks, that means the beneficiary might have to front $10,000 or $15,000 out of their own pocket and wait to be reimbursed.
That is the essential planning element that so many people miss. The policy mitigates the cost, but it doesn't always eliminate the immediate cash flow problem for the beneficiary.
That is a true deep dive insight right there. The policy guarantees the money will come, but not necessarily on the timeline you need it.
Exactly. And it's why choosing your beneficiary is so important. They need to be able to handle that temporary gap.
So what does this all mean for you, the listener? Our deep dive confirms that final expense insurance is a specialized tool for a very focused goal. It ensures funeral costs are covered without all the underwriting hurdles.
And really, it's a loving, pragmatic gesture. It secures the funds so your loved ones can grieve without scrambling to pay five-figure bills on just a few days' notice.
Absolutely. But this brings up one final provocative thought for you to consider. Since the payout is small and might take a few weeks to arrive, does your planning really end with just buying the policy?
Good question.
You need to ask yourself, does that fixed payout actually align with funeral costs in your specific city? And even if it does, have you talked to your beneficiary about that potential cash flow gap? Do they have the funds to manage until the insurance money clears?
That conversation, connecting the policy to the real-world bill from the funeral home, that's the true mark of being prepared.
There's always more to learn and more to plan. Thanks for diving deep with us today.
That's it for today's MeetSean. If this helped, follow the show and share this episode with one person who needs it. See you next time.